Hi everyone. Today we are going to learn about bonds. So, what is bond? A bond is simply a loan that is taken out by a company. Instead of going to a bank, the company gets the money from investors who buy its bond. In exchange for the capital, the company pays an interest coupons, which is the annual interest rate paid on a bond expressed as a percentage of the face value. So bond is a fixed income instrument. It is a loan made by an investor to a borrower. It is an IOU between lender and borrower that includes the details of loan and payment. So what is IOU? An IOU is a phonetics acronym of the words IOU. It's a document that acknowledges the existence of a debt. An IOU is often viewed as an informal written agreement rather than a legally binding commitment. Next is why bond is needed and who uses it. Companies issue corporate bonds to raise money for variety purposes, such as building a new plant, purchasing equipment, or growing the business. Bonds are used by many companies, municipalities, states, sovereign governments. It is used to finance the projects and operations. Owners of bonds are debt holders or creditors of the issuer. What is bond details? Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually include the terms for the variable or fixed interest payments made by the borrower. So generally here bond details means the details about issuer will be given, details of the coupon will be given and maturity date. So what is issuer? That is the company, province or country that is issuing the bond. Okay, that is the issuer. Then coupon is, it might be fixed or it might be variable interest rate, and maturity date, that is the date on which the borrower will pay the investors their principal back. Next is who issues bonds. Bonds are issued by generally governments and corporations when they want to raise money. By buying a bond, you are giving the issuer a loan and they agree to pay you back the face value of the loan on a specific date and to pay you periodic interest payments along the way, usually twice a year. So, issuers sell bonds or other debt instruments to raise money. Most bonds issuers are governments, corporates, banks, etc. So, government and corporates commonly use bonds in order to borrow money. Government needs to fund roads, schools, dams, or other infrastructures. Corporations need to grow their business, for example, to buy property, to buy an equipment, to undertake profitable projects, research and development, or to hire resources. Then how bonds work? Already I think we have discussed about it. So whenever an issuer, whether a company, corporate or government, need to raise money, they issue bonds directly to the investors. The borrowers issues a bond that includes the terms of the loan, interest payment that will be made, and the time at which bond principal must be paid back on maturity date. The interest payment, the coupon, is part of the return that lender or the bondholders earn for loaning their bond to the issuer. Now, how does a bond differ from stock? Stocks means the ownership in a company. Bonds are a loan to a company or government. Stocks typically trade on various exchanges, while bonds are mainly sold over the counter rather than in a centralized location. Stocks have historically delivered higher returns than bonds because there is a greater risk that if the company fails, all of the stockholders' investment will be lost. And now the next question is, what are the key components of a bond? I believe we have already discussed about it. Bonds have three main components. First is principal, then coupon rate, then the coupon rate means the interest rate, and the maturity date. These three components are used to calculate a bond's yield. The principal of a bond is also called its face value or par value. Refers to the amount of a money that issuer agrees to pay the lender at the bond's expiration or on maturity date. The coupon rate is the percentage of the principal paid back to the investor as interest. Whatever the principal is, the coupon rate is a percentage of that value. The bond maturity date is the date on which the principal must be paid back to the bondholder. Now, what is the coupon rate of a bond and how is it determined? So, coupon rate means the interest rate that is provided to the bondholder. The coupon rate is the annual income an investor can expect to receive while holding a particular bond. It is fixed when bond is issued and is calculated by dividing the sum of the annual coupon payment by the par value. Par value means the face value or the principal value. For example, we can take ABC Corporation. It releases a bond worth $1,000 at issue. Every 6 months it pays the bondholder $50. So annually 50 plus 50, $100. It is the issuer is paying to the bondholder. So how to calculate the coupon rate? Coupon rate is sum of the annual coupon divided by per value or face value. So here annually it is paying $100 divided by face value is $1,000, that is 0.10. The bond's coupon rate is 10% here. This is portion of the of its value that it repays investor every year. Now, bond coupon rate versus interest. Coupon rate could also be considered as a bond's interest rate. In our example, the $1,000 pays a 10% interest rate. Investors use the phrase coupon rate for two reasons. First, a bond's interest rate can often be confused for its yield rate. The term coupon rate specifies the rate of payment relative to a bond's par value. Secondly, a bond's coupon is often expressed in a dollar amount. For example, a bank might advertise its $1,000 bond with a $50 semi-annual coupon. This is another way of saying that it pays a 10% of return. Next is how do bond prices and interest rates relate to each other? What is the impact of changing interest rates on bond prices? Bond prices have an inverse relationship with interest rates. This means that when interest rates go up, bond prices go down, and when interest rates go down, bond prices goes up. The reason the price of a bond reflects the value of the income it delivers through its coupon or interest payments. If prevailing interest rates are falling, older bonds that offer higher interest rates become more valuable. The investor who holds these bonds can charge a premium to sell them in the secondary market. Alternatively, if prevailing interest rates are increasing, older bonds become less valuable because their coupon payments are now lower than those of new bonds being offered in the market. The price of these older bonds drops and they are described as trading at a discount. Next is what is the maturity date of a bond and why is it important? The maturity date refers to the date when the principal amount of an investment such as a bond, note or other debt instrument becomes due and is repaid to the investor. Maturity dates help lay out the timelines of investments or loans and can affect interest rates and the level of risk associated with products. As we have discussed earlier, there are two types of coupon rate. One is fixed rate, another one is floating rate bond. So what is fixed rate payment? So interest payment that remains same amount for the entire term of the security or contract is called fixed rate bond. And what is floating rate payment? Floating rate payment is interest payment that periodically change according to the rise and fall of a certain interest rate index or specific fixed income security which is used as a benchmark. What are the major credit rating agencies? Why are credit ratings essential for bonds? So major 95% of the credit ratings are controlled by Moody's, Standard & Poor's, S&P and Fitch Ratings. Other credit ratings rating agencies that play the similar role are Dun & Bradstreet, DBRS and Bureau van Dijk. Why it is essential? A high credit rating indicates that in the rating agency's opinion, a bond issuer is likely to repay its debt to investor without any difficulty. A poor credit rating suggests it might struggle to make its payment or even fail to make them. The next is what is bond yield and how it is calculated. Already we have discussed what is coupon rate. Nominal yield is nothing but the coupon rate. So what is coupon rate? How to calculate it? We have already discussed it. The sum of the coupons annually divided by the principal amount or the par value or the face value. So it is here in the example, if a bond with $1,000 face value that pays $50 annually. In our previous example, I had provided $50 semi-annually. So 50 plus 50, it was 100 annually. Here it is $50 annually, has a nominal yield of 5%. That means coupon rate is 5%. 50 divided by 1000, that is 0.05. For fixed rate bonds, the nominal yield always remains consistent. But for floating rate coupon, it differs. It depends upon the repo rate, reverse repo rate, etc. Then what is YTM or yield to maturity? Yield to maturity is the total return anticipated on a bond if the bond is held until it matures. Yield to maturity is considered a long-term bond yield but is expressed as an annual rate. It is also known as redemption yield. Yield to maturity is also useful as it allows the investor to gain some understanding of how changes in market conditions might affect their portfolio, because when securities drop in price, yields rise and vice versa. Generally, there are two types of bonds, that is callable and another one is non-callable. Callable bonds can be called away by the issuer before the maturity date, but it is quite riskier than the non-callable bonds. However, callable bonds compensate investor for their higher risk by offering somewhat higher interest rates. The issuer of non-callable bonds can't call the bond prior to its date of maturity. One of the most common non-callable bond is US Treasury stock. For non-callable bond, the bond's issuer faces a risk as the interest rate is locked in until the bond matures. The interest rates of non-callable bonds tend to be lower than the interest rates of callable bonds. Describe the term bond duration and its role in assessing interest rate risk. What are zero coupon bonds and how do they work? Bond duration is a measurement that tells us how much a bond's price might change if interest rates fluctuate. Its full definition is actually a little more technical than that, since duration measures how long it will take an investor to be repaid a bond's price from the cash flows it produces. After all, bond investors are placing loans to a borrower which must be repaid with interest by their maturity date. Bonds with high duration are more prone to the ups and downs of the market volatility that happens in an environment of changing interest rates. Bonds with highest duration are typically long-term bonds with low coupons. And what about low bond duration means? Low bond duration means the bonds that have lower duration are more stable against interest rate fluctuations. So these bonds are typically shorter term bonds. Then what about zero coupon bonds? The easiest duration to calculate is that of a zero coupon bond. This bond has zero yield, which means it does not pay any interest. Its duration is equal to its time to maturity. When a coupon is added to a bond, the duration will always be less than its maturity. Explain the relationship between bond prices and inflation. If market participants believe that there is higher inflation on the horizon, interest rates and bond yields will rise and the prices will decrease to compensate for the loss of the purchasing power of future cash flows. Bonds with the longest cash flows will see their yields rise and prices fall the most. A rise in their interest rates or the inflation rates will tend to cause bond prices to drop. What is a bond ladder and why do investors use it as a strategy? A bond ladder is an investment strategy that involves constructing a portfolio in which bonds mature continuously at equally spaced intervals. The investment strategy can be used to retain liquidity while also taking advantage of generally high yield long-term bonds. It is a portfolio of individual certificate of deposits or bonds that mature on different dates. This strategy is designed to provide current income while minimizing exposure to interest rate fluctuations. There are many risks associated with investing in bonds. The first risk is when interest rates fall, bond prices rise. Then second risk is having to reinvest proceeds at a lower rate than what the funds were previously earning. The third risk is when inflation increases dramatically, bonds can have a negative rate of return. Then fourth one is corporate bonds depend on the issuer's ability to repay the debt. So there is always the possibility of default of payment. Risk 5 is a low corporate credit ratings may cause high interest rates on loans and therefore impact bondholders. The sixth one is low liquidity in some bonds can cause price volatility. How does the risk of corporate bonds compare to that government bonds? Corporate bonds are generally considered riskier than government bonds because government have the option of raising taxes to meet their obligations. If the issuer goes out of the business, the investor may never get the promised interest payments or even get their principal back. Corporate bond investor earns extra yield by taking on greater risk. Most corporate typically have more credit risk and higher yields than government bonds of similar maturities. So what are the different types of factors one investor should consider when selecting bonds for their portfolio? The first factor that an investor should look into is the risk, assessing risk. Then price, what is the price of the bond? Then what is the interest rate of the bond? What is the maturity date? Redemption features, conversion rate, then principal payments and average life, then yield, credit quality, credit ratings, bond insurance and tax status should be considered. Next is what are the advantages and disadvantages of investing in bonds compared to other investment options. Bonds have some advantages over stocks, including relatively low volatility, high liquidity, legal protection and various term structures. However, bonds are subject to interest rate risk, prepayment risk, credit risk, reinvestment risk and liquidity risk. The other advantage of a bond fund is that interest payments can be automatically reinvested, which tends to lead to growth over time. Bond funds are not a guarantee. They can diminish in value, particularly in the short term, and investors can lose money just as with stock funds. Thank you. If you want to learn some other topics, please let me know so that I can prepare and share with you. Thank you.